Hello, and welcome back to Make Finance Easy. In 2012, Meta bought Instagram for $1 billion. At the time, Instagram had 13 employees, no revenue, and a free app. Today, that single acquisition generates tens of billions of dollars yearly. But for every Instagram, there's a failed deal that destroyed value. So, what separates a great merger and acquisition from a disastrous one? The answer is in size, it's strategy, valuation discipline, and execution. A merger sounds equal. An acquisition is about control. In 90% of mergers and acquisition deals, one company controls management, capital allocation, and long term strategy. Take Disney and Fox, for example. It was called a merger, but Disney decided what stayed, what was cut, and where the cash flowed. Control is obtained through stock purchases, asset purchases, or tender offers. The legal form matters more than who controls the cash flow. There are six real reasons why companies pursue mergers and acquisitions, and only a few work consistently. Speed. Buying growth is faster than building it. Meta did not want to outcompete Instagram, it bought it. Number two, synergies. I feel like this is the most abused word in mergers and acquisition. Cost synergies come from eliminating overlap. Revenue synergies come from pricing power and cross selling and are harder to achieve. Number three is scale and market power. Bigger firms negotiate better, price better, and survive downturns longer. Number four, strategic defense. Sometimes mergers and acquisitions is what preventing competitors from gaining assets, a major driver in the tech deals. And number five, strategic assets, such as patents, data, brands, or talents. Google buying YouTube wasn't about the revenue, it was about control of attention. And last but not least, financial engineering. These include tax shields, leverage, and balance sheet optimization, which are especially common in private equity. Now let's look at different deal types. Horizontal mergers combine competitors and attract regulators, like large banks or airline deals. Vertical mergers lock down supply chain and reduce risk. Conglomerate mergers diversify revenue but often trade at discounts due to the lack of focus. These deals can be friendly or hostile, cash, stock, or mixed, public or private. Private equity uses leveraged buyouts, where debt magnifies returns and magnifies mistakes. Most mergers and acquisition failures start with overpaying. Bankers triangulate value using comparable companies, multiples like EV and EBITDA. Precedent transactions, which embed real control premiums, DCF models discounting future cash flows using WACC, which is when buyers often pay 20 to 40% premiums. But the key question is, do synergies justify the premium? If a deal is EPS dilutive with no clear long time upside, it's usually a red flag. Over 70% of mergers and acquisition deals fail, not because of bad strategy, but bad execution. In that, due diligence looks at quality of earnings, legal and regulatory risk, customer concentration, and culture and incentives. Most value is created or destroyed after the deal closes. Integration speed beats perfect planning. Great mergers and acquisitions isn't about buying companies, it's about buying cash flows, capabilities, and control at the right price. That's why understanding mergers and acquisitions is foundational for investment banking, private equity, corporate finance, and serious investing. And that's it for Make Finance Easy. And I'll see you guys next week.